Hi everybody, I'm AJ Singh, CPA from GNS. Today we're going to be talking about the California Franchise Tax Board and how it differs from IRS Collections. What causes a franchise tax board liability? How can you resolve it? What are the different methods of resolving it? And a little bit about the differences between the collection efforts from the two taxing agencies. The IRS is a lot more lenient than the Franchise Tax Board. The IRS will often give you first-time abatement of penalties, whereas the Franchise Tax Board will only abate your penalties if you have reasonable cause. Also, there is a big difference in installment agreements. The IRS will allow streamlined installment agreements without financials for tax liabilities under $50,000, whereas the Franchise Tax Board, the threshold is $25,000. So if you go over $25,000 in your tax liability, you will have to submit financials. So a financial statement is basically your assets and liabilities, and income statement of what you earn and what your expenses are. Financial statement can be provided for a business and for individuals also. So the IRS and the Franchise Tax Board have certain forms that you can provide this information on. So what causes a franchise tax liability to be incurred? Why would you get hit by penalties and interest? So a few reasons I will list over here, but the article will discuss this in more detail. If you have unfiled returns, the Franchise Tax Board will file them for you and send you an assessment. This will have penalties and interest on it. So the best thing to do is file a tax return so that the correct balance can be posted on your account. The Internal Revenue Service may audit you, and then they send those adjustments to the Franchise Tax Board, and therefore your balance with the Franchise Tax Board now changes, and then you have a balance that needs to be paid off. If you have disputed an audit successfully with the IRS, then the Franchise Tax Board may need to know that, and that will reduce the balance with the state. There could be discrepancies in the amount reported on a tax return. So if there's an unreported W-2 or 1099 form, the Franchise Tax Board will get to know about it, and then they will send you a notice of adjustment, which will have a balance and potentially penalties and interest. So like I mentioned before, the IRS is way more lenient than the Franchise Tax Board, but there are resolutions available for your tax liabilities with the state. That includes the installment agreement, whether it's with a financial or without a financial statement. There's also offering compromises available. You can also get a temporary delay in your collection activities, for example, if you need time to file a tax return or respond to the notice. And penalty abatements can be achieved if you have reasonable cause. We'll also list a few examples of reasonable cause within this article, so you can take a look at those. So please review this article. If you have any questions, you can always call us at the office. We help many clients resolving tax liabilities. I'm AJ Singh, CPA from GNS Accountancy. I'll see you soon.